Well, the biggest concern of this day of rage will spread into, obviously into Saudi Arabia, but then again in Kuwait, because that's what's happening now. We're hearing rumors that there's demonstrations being filed in Kuwait where people want more freedom. And so therefore, we're looking at two huge oil producers of Saudi Arabia and Kuwait, much different than Libya. I mean, Libya is a rounding error, 2% of global capacity. If Saudi Arabia and Kuwait get into the act, we could see $120 barrel oil with no problem whatsoever. So I think that's why the markets are so volatile right now.
How quickly could we see it? What are you hearing there?
I'm sorry?
How quickly could we see a rush towards 120 a barrel?
We could see $120 a barrel if we have a major disruption in Saudi Arabia and or Kuwait. Other than that, I don't think we'll see it because there is so much spare capacity in the market. And OPEC comes out every time saying we have so much capacity, 4.5 million deliverable barrels of oil ready to sell into the market to keep the price down. I mean, they like a $100 barrel of oil, but they don't like a $120 barrel of oil coming up so quickly. So I don't see it happening unless there's some major disruptions in Saudi Arabia on the 11th. And I think that's an outlier.
And you don't see a return to the oil shocks of the 1970s. You've been going back in history, some compelling evidence to suggest we could actually absorb some supply outages. If so, why so?
Yeah, like there's a lot of things that are different. Think about the oil embargo of '73, the Iranian Revolution '79, even Kuwait in 1990. We had oil spikes of 150 to 350% during those times, and all of them sparked recessions. Right now, the last 2 weeks, we've had oil go up 25%. The equity markets actually have only gone down 2%. So who do you listen to, the economists or the stock market? I happen to listen to the stock market, people that have skin in the game. There's spare capacity. The global oil GDP is much lower than it has. Right now, it's down 30% from even what it was in 1990. Our dependence on oil is much less. So what I'm saying by that is that the inflation follow-through from this could be a lot less. Our usage of oil, in terms of how much the GDP is was 50% down to 30% if you compare 1970s to today. And also, producers, suppliers, and OPEC all have room to sell. And once this thing gets figured out, they will sell.
And yet you are saying Europe, of all the continents, could be the most vulnerable. Why?
It's funny because the markets don't like surprises, and it seems like there's so many surprises. And a good example of that, nobody cares about the U.S. problems right now. We're funding our deficit with shoestring and bubble gum. Nobody cares about what's going on in Europe. The Portuguese bond issue that came out was terrible. And there seems to be a lot of talk about the summit in March that's coming out. Won't be as good as they first thought. Everybody's focused on oil. Every surprise that comes out of the woodwork is going to shock oil, even though there is supply, even though OPEC's trying to tell everybody we have the capacity to pour oil on the market.
Larry, Simon here from Sydney. Would you say that these sort of events lead to an instant rebuilding of inventories in the States, or do you have any data on that for us?
I don't think it's going to have any immediate impact except for people just being fearful. There's a lot of cash on the sidelines. But the fact of the matter is, if you listen to history, if you look at history, you'll say, a 10% spike in oil, a sustained spike in oil, is going to hurt stocks in the long term by like maybe 1% of earnings per share. And the same with global GDP. 10% rise in oil is going to affect the global GDP by 1/10%. There are so many other things to worry about right now. I don't like paying as much for gas as I'm paying right now, but this seems to be a short-term a spike in oil. Hopefully, it'll calm down very shortly, and we can get back to business.
So if the price doesn't calm down, you're saying it's pretty unlikely markets can keep punching ahead, as the States has certainly done more than Australia.
Oh, that is quite true. But think about it, as I've just said, the stock market has only gone down about 2% in the last 2 weeks with a 25% spike in oil. I listen to the stock market, people that have skin in the game. And this grand notion of randomness that surrounds us, I mean, you'd think the stock market should be down a lot more, and think the stock market's saying this correction is temporary. Yeah, we're worried. Option volatility is very high, but we've only corrected 2%. Not a big deal in the scheme of things.
You could acknowledge, though, Larry, and another of our guests has made this observation himself, to say, well, the markets are pricing in certain event risk that's quite different to the rest of the economy. And I'm not talking just about economists. I'm talking about people out there at the Bowser even who aren't showing up in their SUVs to fill up.
Yeah, actually, I think that it is all priced into the market because people are viewing this as a short-term event, although oil still is higher, and Brent did rally today, and Brent obviously is the better gauge of gas prices, jet fuel, diesel, and all that sort of thing. So we'll have a temporary problem with supplies in the market from manufacturing, of course, but that's only if it's going to last for 3 months or more. If we can get this thing down back to like $90 a barrel, where oil deserves to be right now, given the supply factors, this shouldn't be a problem. GDP will be shaving a little bit around the world, but long term, we should be okay.